Welcome to This Explainer. Today, we're unpacking the absolutely wild financial metrics behind Arrowhead Pharmaceuticals. If you follow the biotech sector, you already know it's a space where fortunes can be made or completely wiped out overnight based on clinical trials and FDA news. But today, we're tossing the medical jargon aside. We're just looking at the cold, hard numbers to decode the exact story Arrowhead's raw data is telling us right now. Okay, let's jump right in with a truly staggering number. A 418.71% return over the trailing 12 months. Literally, just let that sink in for a second. If you had parked some capital there a year ago, it would have more than quintupled by now. Naturally, a meteoric rise like this begs the obvious question. What exactly is fueling this rocket ship? And more importantly, can they actually keep it up? To figure that out without getting completely lost in the spreadsheets, we're going to slice Arrowhead's data into 5 parts. The explosive short-term surge, their history of volatility, the revenue and cash flow fundamentals, measuring the valuation, and finally, their overall debt and financial health. All right, starting with Section 1, the explosive short-term surge. Let's look closely at exactly how explosive this run has been. Down in May of 2025, the stock hit a 52-week low of just $12.44. Since then, it's skyrocketed an astonishing 463% to close recently at $70.13. For anyone watching the markets, seeing a nearly vertical climb like that is both exhilarating and, honestly, a little terrifying. It completely reframed the company's market cap, launching it up to nearly $9.8 billion. Now, breaking that momentum down a bit, the immediate 7-day window does show a very slight dip of about 1.3%. But zoom out just slightly, and the broader 30-day trend is still incredibly strong at nearly 22%. What this tells us is that despite taking a tiny breather this week, the market's recent appetite for Arrowhead shares has been absolutely voracious. Which brings us to Section 2, a history of volatility. Because to really get Arrowhead, you can't just look at a few months of high-flying data and assume you've got the whole picture. We have to zoom out. And what's really jarring here is the contrast. We've got those massive trailing 12-month gains we just talked about and a very respectable 3-year return of 98%. But look at that 5-year return. Despite the massive recent rally, if you had bought and held exactly 5 years ago, you'd actually be down nearly 8% today. It perfectly highlights how tricky it is to time your entry with these high-beta biotech stocks. We are literally seeing the classic biotech roller coaster in action here. You've got years of massive triple-digit gains, like in 2018, 2019, and 2025, which are immediately followed or preceded by gut-wrenching double-digit sell-offs, like that negative 38% drop in 2024. This definitely isn't your grandfather's slow and steady dividend stock. This is a company whose valuation violently reprices based on pipeline developments and market hype. Moving right along to Section 3, revenue and cash flow fundamentals. With returns swinging that wildly, we absolutely need to look under the hood at the actual fundamentals driving the business today. Because let's face it, hype only takes you so far until the balance sheet has to step up. Looking at the top and bottom lines, the story is phenomenal. Arrowhead generated over $1 billion in revenue over the last 12 months. And even better, they retained a super healthy $202 million of that as pure net income. For a biotech firm crossing the bridge from cash-burning research to actually printing $1 billion in revenue and finding bottom-line profitability, well, that's a massive milestone. But the most crucial point here is that completely staggering 43,539% jump in trailing 12-month revenue growth. No, that is not a typo. That is exactly what happens in biotech when a commercial engine suddenly roars to life and recognizes massive milestone payments. It totally blows their still impressive 3-year average growth rate of 57% out of the water. And what's incredibly encouraging for investors is that their free cash flow is sitting at over $322 million, offering a solid 3.28% yield. They aren't just paper profitable, they are generating real, tangible cash. Let's jump into Section 4, measuring the valuation. So with all that astronomical short-term growth and newly minted profitability, we have to ask the multi-billion-dollar question. Is the stock overpriced right now, or does the growth actually justify paying a premium? To figure that out, let's quickly anchor ourselves on the P/E ratio, our standard gauge for how much investors are willing to pay for a single dollar of profit. Arrowhead currently sits at a P/E of 45.54. Now, that's definitely a premium valuation, but certainly not unheard of in the biotech world. However, notice that forward PE of 111.11. Because that forward multiple is so much higher, it tells us the market is anticipating a near-term dip in earnings, likely because they're going to aggressively reinvest that cash back into heavy clinical trials. Still, it's an incredible shift when you realize their trailing 12-month average PE was a deeply negative 155. They've successfully crossed the threshold from a money-losing promise to a highly valued, profitable reality. Adding price to sales and the PEG ratio into the mix builds a pretty complex valuation picture. Sure, they traded a hefty 9 times their sales, but here is the real kicker, a PEG ratio of just 0.35. Since a PEG ratio under 1 usually suggests a stock is undervalued relative to its growth rate, this implies that the current price, despite that massive run-up we saw earlier, might actually be reasonable if their explosive earnings trajectory holds up. And that brings us to our final part, Section 5, Debt and Financial Health. Let's assess the actual financial foundation supporting this valuation, because as we all know, even the highest-flying growth companies can crash hard if their balance sheet can't handle the weight. Doing a quick liquidity check in step 1, things look amazing. With a current ratio of 3.38, for every single dollar Arrowhead owes in the short term, they have over $3 in liquid assets ready to cover it. That is a massive safety net. Step 2 shows a really balanced capital structure. With a debt-to-equity ratio just over 1, they're certainly using leverage, but they are absolutely not drowning in it. On top of that, their profitability metrics are exceptionally strong right now. A return on equity of nearly 36% means they are generating huge, highly efficient returns on shareholder capital. Similarly, pulling in over a 30% return on invested capital tells us the management team is doing a phenomenal job turning their cash investments into highly profitable returns. So, given the wild historical volatility we've looked at today stacked up against their massive fundamental growth, they just crossed $1 billion in revenue and have a PEG ratio screaming value. We're going to leave you with this to ponder. The numbers show a company that is fundamentally transforming, but in the biotech sector, the past is rarely a smooth predictor of the future. Is Arrowhead's explosive growth already fully priced in, or is this biotech roller coaster just getting started? Thanks so much for joining me for this explainer, and keep learning.